of situation. But again, I think Len makes a good point that you could certainly participate in this on an ETF level, and you'll own the ETF. It'll either go up or it'll go down, or it'll go sideways, one of the three. But you'll
But
feel
how-
like you're involved.
How liquid are they?
Oh, you can buy and sell them the same day if you wish. They trade on the exchange.
Yeah, the two that I'm familiar with, I think it's called GWBC,
hmm
something like that, and there's an OBBC, something like that.
There's a few of them that are coming out, in other words, but I think if people, unless they're dying to, I think they ought to wait and see what else is coming in the next few months. A company by the name of Grayscale created one that seems to be approved by the regulators also.
Yeah, that's the one that I'm familiar with.
Yeah. But again, if you feel no rush to get into this, then just wait and you'll see by late spring or summer, there'll be a number of products that are going to be approved by the regulators. Okay. And like I say, you treat it not like a currency, treat it like a collectible commodity. In other words, make it a small part of your portfolio and know that there's a possibility of losing as well as gaining. That's all. Okay.
Yeah,
So
but the Grayscale one has a 2% fee, I think.
look, whatever it is, either you want to get in on it or you don't. Don't nickel and dime yourself.
No, but
if not, then if that's okay with you, fine.
Yeah, the other day it was around 40 or 39 even, and today it was up to 57 or something like that.
Correct. They'll definitely be. The government is and the regulators have been a little slow on this because they're trying to figure out how they should classify it. So I don't know that there's any rush, but if people are so rushed, like I say, just put in the money that you know that you can afford to not have, and that's a good way to do that type of investing. Okay.
Did you get any questions, Len, that we could address first?
I did not.
Okay.
Okay.
I did get several people asking.
Somebody's raising their hand. Yeah.
Me.
Okay,
Okay.
Barbara,
What's the
go ahead.
question?
Yeah, you were talking about alternative investments. If you guys have any interest at all in collectibles, meaning sports collectibles, etc., my older son works for Heritage Galleries, and he could probably talk on the subject, at least in the sports division.
Okay.
Yeah, I'll call you, Barbara,
Mhm.
and we can figure that out.
And again, at 2 meetings ago, we say if there is inflationary pressure that may come onto the marketplace by the end of this year or next year, collectibles that's been in the, pretty much down in the gutter for the most part, and has been a dog for the last 10 years. As you get inflationary, collectibles tend to then rise, whether it's art, baseball cards, whatever. So just know that may come into play over the next 12 to 24 months. Okay.
You want to talk about asset allocation?
Sure. Go ahead, Mo.
All right. I think the first thing you have to do to have a basic portfolio is create or come up with what is the appropriate asset allocation for you. And what are the things that will determine that? In other words, what are the variables? Anybody? As we all have an asset allocation, what did you base it on?
By the seat of my pants.
Right.
Okay,
Sure.
a lot of people, they buy a lot of different things, and whatever they end up with, they call that a portfolio. Asset allocation, a couple of things, depends, number one, on age. Okay, if you're 92, you have a different allocation than if you're 22. The other thing is, do you need income from your portfolio? If you need income from the portfolio to supplement other sources of income, that can determine the asset help you determine asset allocation. Whether you need to leave money to anybody, to children, determines asset allocation. So generally, for most people, the asset allocation is probably going to be somewhere between, let's say 35% and 75%. 35% being very, very conservative, and 75% being a little bit aggressive. But again, if you were 92, 75% might be or too aggressive, obviously. So, once you determine the asset allocation, then the next step comes in. Okay, how do you populate the portfolio of stocks, the portfolio of bonds, and how much cash do you want to keep? So let me stop there and see if there's any questions so far.
Well,
What's your feeling about bonds
Okay, right now.
right now?
Yeah,
Not-
if you want to invest in bonds, you want to stay in good quality bonds, you're probably talking about, 1 to 1.5, maybe 2% at most. And then you still have to go out 6, 7, 8, 9, 10 years. 10-year treasury is 1.5 today. So if you bought a 10-year treasury and you put $1 million into it, you're going to get $15,000 a year. Not a lot of money for $1 million.
Right.
So what we've done is we've bought some high yield bonds, and we bought them through closed-end funds. Closed-end fund is like a mutual fund, except it trades like a stock on the stock exchange. So these.
Do you buy only if it's a discount?
No, buying them based on the yields. Okay, they've got anywhere from, let's say, 4.5%, 5% to as high as 8, 9, or 10%. But they have risk. They don't come without risk. But if you say, if you had going to put, let's say, $100,000 into bonds, maybe you put $20,000 into the high yield bonds using a couple of these closed-end funds, and the rest you put into quality bonds and take your 1.5%, 2%. So it's not a great time to buy bonds. And
It all depends on whether you need this for income or not. In other words, I think that's how you approach this.
But let me throw a little different light onto it. If you don't need the income,
uh-huh.
why would you buy bonds, especially individual bond, or versus buying dividend stock? If you buy high yield bonds, isn't it almost like buying a stock with a yield that's on dividends? There's not much difference.
It's probably not as volatile as the stock, but it is volatile. So if a stock has a volatility, let's say 1 to 10 would be 10, this might be a 7.
Yeah.
It's still
And
gonna
on the debt scale, the bonds are higher up on the ladder than just common equity. So you should know that. So in case whatever the company is. The other thing is that you would be buying bonds. You may want to go, depending on your income bracket, you may want to be in municipals. So that's a different situation than just getting a dividend that's taxable, depending on what income bracket you're in. Yeah.
Mike, there's 2 reasons I would give as to why you buy bonds. One is you want an assured income stream. Okay, bonds give you an assured income stream. The second reason is you don't want to own stocks, or you don't want to put that money into stocks. So those are really the 2 main reasons why people buy bonds. So if you don't put it into stocks and you don't put it into high yield bonds, you put it into regular bonds, you're going to get 1.5%. And that's where the market is. Maybe rates are going to go higher in the next couple of years, but in the meantime, they're down low here. So you say it's not worth to put $1 million in and get $15,000 a year. So just keep it in cash and earn nothing. So you'd miss out on the $15,000.
And some people and some investors, they can't take the volatility of the market, whether you have a dividend or not. So you have even dividend paying stocks that may go up 10, 15, 20% up and down. Your bonds will be much steadier. So if you can't take the volatility, you may want to have more assets over on the fixed income side. I think Morley brings up a good point. And are you the gentleman that checks out every CD and the banks? You were the one that sort of told us where to get the best CD.
That was last year. You can't do that.
How are you doing this year?
Well, I don't have it in CDs right now.
Okay, so where did you put the CD money?
Well, some in cash and the rest into.
So the cash earns nothing. Yeah, go ahead.
Mainly into dividend funds.
Dividend.
Instead of having it in cash, I went into not so much high yield dividend funds, a more consistent with funds where they're if the dividend payments keep on going up.
Is this stock
Over-
dividend?
You're talking about
This is-
stocks that pay dividends. Is that what you're talking about? Stocks that pay dividends?
Dividends, increasing dividends mainly through an ETFs.
Through ETFs, okay. And what's the yield on these ETFs? What are you getting as yield?
Anywhere from 1 to 4%, or 2 to 4%.
2 to 4%. Taxable, right?
Yes.
Well, you can do the same thing, just to tell you, and going back to what Morley said, you can do the same thing. Again, most people go, if you're buying dividends, see, most people buy stocks and the dividend is a plus. So they look for total return. Stock goes up plus the dividend. You've done very nicely. You've offset any inflationary pressures, etc. If you're looking for pure income, then and take a look at what you're reporting on your AGI, adjusted gross income. You can just as easily, as Morley indicated, you can just as easily get closed-end funds that are run by very reputable companies, BlackRock, Nuveen, so on and so forth, that have tax-frees in there anywhere from 3 3/4 to 5% and pay monthly on top of that, okay? So, and very easily accessible. So if you're looking for your income and you're looking for your after-tax income, I suggest you look at a little bit of an alternative, especially if you're buying the equities kind of just for the dividends that are taxable.
No,
Do these closed-end bond funds, I'm not that familiar with, but do they also have return of capital features in them?
Some do, but most of them don't anymore.
Yeah,
They
because
just-
that made the rates very misleading a few years ago.
Sure, no.
Because you were
I
getting
mean,
your
you
own
can-
money back.
Right, you can get that, right. But if you take a look at these and go in small, start with $5, $10,
Yeah, okay.
$15,000, but you'll find that especially if you're using them for an income stream, they pay monthly and you can set your watch to it, okay? And not very volatile, I should say, outside of a pandemic. So hopefully this happens once every 100 years, you know?
Well,
And
if
some of
rates go up, doesn't the principal go down, or is it not affected that way?
No, it'll like Morley said, there is risk here. So first of all, step back. Why are you buying them? You're buying them for income stream, okay? The income will stay the same. You're asking what the net asset value is, what the value of the fund is. If you're buying it for income and it's selling at $15 a share, it doesn't make any difference if it's $14 a share, except it's an opportunity to buy a little more yield at a cheaper price, okay? So what happens? What you just said, interest rates go up. So new paper comes onto the market with a better coupon. You have to wait for these funds. They have every piece of paper that you could want coming due every week, every month. So as they have their lower yield come due, they're going out into the marketplace to take that money and buying a higher yield. They'll catch up and it'll start to go. But you're right, looking at the first 3, 6, sometimes 9 months in a rising interest rate, your $15 a share may go down to $13.80. But why did you buy them in the first place? You didn't buy them for total return. You bought them for income. As long as they're paying you the income that they promised you at the beginning, that you saw, okay, you're fine. Just take a little bit of the volatility in the fund and you're getting the income every month. Yeah.
And
You
some
follow
of these
what-
funds use leverage, and that's also how they increase their
Their yield.
income.
Absolutely. Did you understand what I just said, or tell me if not, I'll go over it again. Did you understand on the ET?
I understand what
Yeah.
you said. My
Okay.
concern is, what if rates really do go up and get back to what I'll refer to as normalcy of 10, 20 years ago? Would principal go down by 50%, not just a few percent?
No, it won't go down because they'll be replacing as it goes up. So again, there's risk in everything. okay? The risk that you're taking, that you're stating, is extremely low when you take a look at what the Federal Reserve is telling you, okay? It only befits the Federal Reserve to do it as it befits the Treasury. Who's the biggest debtor in the world? The United States government, okay? It behooves them to keep rates low, okay? So as a result, not that they won't go up, because you saw the bond market on the 10 years start to creep up over this last month or so. But if you're talking about that, you think the 10-year is going from, where was it this afternoon morning, 151, 152, something like that? Yeah, so if you think that it's going from 152 to 3, I don't think you have to worry about that too much. You think it may go to 160 or 170? Sure, that's a possibility.
Yeah, but let me just answer that question.
What's your view toward using floating rate, like low duration, floating rate bond funds? Not today, but say 6 months from now, when interest rates might start going up, or a year from now, whatever it is. What's your view? You get very floating rate. You can get them. They're very low duration. You know, half a year, 30 days. Some of them.
Right. The closer you're going to get, look, low duration, you're playing defense. So in the low duration, you're getting a defense. Depends what, like Morley says, depends on the yield that you need. Okay. If you don't care about the yield and you're just keeping your asset allocation at 45% fixed income, they play a small part. Generally, I found on the curves in doing this the last 25 years, they don't really perform that well. You do as well as getting something that's leveraged, like Morley says, and going out and just letting your principal go up and down. Don't get, the retail investor gets crazy about their principal, so that if the portfolio drops 4% in 1 month, we're on the phone, okay? We're calling whoever we're calling, all right? The key is not the 4%. The key is what was the investment for? Goes back to what Morley opened up the session. What is your asset allocation? And stay to your mission, okay? Very difficult to run your own portfolio and not be emotionally involved, okay? When you're emotionally involved, that becomes a problem. Yeah?
Yep.
Let me answer, is it Irvin that?
He's the president, but he's an investment guy.
Irvin?
I'm
Okay.
Irvin.
Okay, if rates go up, remember I said you put, let's say 20% of your bond portfolio in high yield bonds.
Right.
The rest you keep in cash if you have to, or if you want to put it into 1% bonds for a couple of years. If rates go up, you take that money that you had set aside for bonds and you start buying the higher rated bonds. But you have to have a portfolio where you know what you're doing and say, that's why I've got this cash here. You know, you don't want to keep 100% in cash and wait for the rates to go up. They may not go up. You know, so it's a balancing game of, you know, risk, reward, and diversification. So if rates go up, that's a good thing if you have a lot of cash, because now you can get a better return. You know, if you get 3 or 4% on your money, that's pretty good today for
Yeah, and it's just like the other gentleman asked, what happens if rates go up? Well, if we go back to Morley's example of asset allocation, and you put 5, 7, 9, 10% in cash for whatever reason, the world is coming apart. Start to use some of that cash when rates start to go up. Again, if you're emotionally involved in the portfolio, you have trouble pulling the trigger. Whether it's a buy or to sell is the worst. Buy is sometimes okay, but to sell, you need, in other words, a certain amount of discipline. You need the discipline in pro sports to play. You need the discipline in portfolios. Yeah, you've got a good game now because everything's going up. So I don't think anybody would raise their hand here at this meeting and say, oh, my portfolio is behind the 8 ball this year. Is anybody losing money this year? Hello? No?
Oh, no.
or even last year.
Or even at this, certainly by yeah, if you look at the rolling 12 months from March 1st to March 1st, right? The world came apart in the second quarter last year and then did a complete U-turn by the summer and went up. So I see conservative portfolios that we have for clients they're up 20 and 25% with a mix of equities. That's how much it shot up. Believe me, that's not healthy. It's going too far. See, it's the tortoise and the hare. Just make sure you're plodding along to whatever your goals are. And I think somebody just said, oh, I really have no, I have no philosophy. I buy this, I buy that. That's how my portfolio winds up. Sit down and structure. If it's 100,000, a million, 10 million, it's the same deal. Structure yourself and stay the course. If you insist on managing your own money, then treat yourself appropriately. Don't throw 50 things against the wall and hope 43 of them stick. You're doing yourself a disservice, okay? And the cost that it does, it's like the cost of money. The cost of it, you don't sometimes even see because you're worried about, spending $5 in Robinhood or, however you're trading. So the cost of money many times is not using your money efficiently. But if you don't see it, and one of the other gentlemen said, oh, you know what? I really don't need the income. I don't. So this is kind of like the investing here is a little bit of play. You leave to your heirs, whatever you leave them, fine. But if you're running it like a business and you're treating yourself properly, then you'll sit down, set out a mission, do like Morley said, asset allocation, and stick to it, okay? Stick to it and reevaluate it mid-year, the end of the year, quarterly. Treat it like it's supposed to be treated, not like a Hail Mary, okay? And many of you, I bet you have in your portfolio stuff that you bought back in 1992, and you don't even know why you have it anymore. Your father gave it to you, this, that. We all get emotionally involved. Take a look at it and see if it makes any sense in 2021.
The next thing, once you determine what your asset allocation should be, then you've got to look at, okay, what should your stock portfolio look like? That part of the portfolio. And, we see portfolios where people come in where they've got 7 or 8 different mutual funds and they think they're well diversified.
Right.
But you look at what the holdings are of all these funds, they're the same type of funds and they have the same holdings. So you really don't have the diversification that you want. Diversification is going to keep you from getting into real trouble, but you have to diversify properly. And, what we do is we're in all different segments of the economy. We don't try to make a bet that, oh, this segment of the economy is going to do well and this one isn't, so I'm going to put a lot of money here. We spread the money around into these different sectors, and we're always participating in things that are going up, but we're also participating in things that may not be doing so well. But when you put them together, it's a good portfolio. As we try to stress, try to get steady type of returns, not big returns one year, and then the next year you get big losses.
Right.
That's tough. So that,
I'll ask another question. I think I may have thrown it out 6 months ago. How many here are forced to take RMDs every year now? Everybody have IRAs that required minimum distribution or no? Yeah.
Well,
most of them.
the answer is yeah. For me, yes.
Yes.
Except
Okay.
for this year, except for
Last year,
2020.
2020. Right. I meant right. Okay. Everybody else takes RMDs also that are out? Yeah. Okay. Good. All right. So take a look that if you kind of think, and again, this is sitting down a mission. If you kind of think under the present administration, sooner or later, months, maybe a year, whatever, somebody is going to have to pay the piper on printing all this money. Yeah. So you're pretty much at a, 22, 23% flat rate right now where you're paying federal income taxes. Let's say for the purpose of this discussion, you have a $500,000 or a $1 million IRA, 401k rollovers, consolidation, inherited IRAs from your folks, whatever. Why don't you think about taking some of that money and take a look and say, well, I know where we are this year as far as federal income tax, because when you take your RMD, that adds on to your adjusted gross income, yes? Take a look and say to yourself, well, the chances are maybe in 22, 23, and probably 22 or 23, 24 becomes an election year, so nobody raises taxes then. Are we going to see some increase in federal income tax? If I was to guess, the answer is probably a yes, okay? If you're going to do it, it's going to probably be in 23 because 22, the Congress is always up for election, all right? Take a look and say to yourself, okay, what if I take out extra dollars this year, right now, where I know where the tax rate is going to be, convert that into your after-tax account, okay? Rather than allowing your IRA to grow ad infinitum, yeah? And bring in some after-tax money to you at probably an advantageous tax rate, okay? I think we can all agree at this meeting, taxes are not going down from here, okay? I think we all can agree with that. Now the question is, are they going up from here? Okay, I'll throw out to you, I think they are probably in the next few years. Because again, someone's have to pay the piper here, all right? So think about if you have a disproportionate large amount of your assets in IRAs, taking some money, putting aside the money for taxes, you have withholding on RMD, and taking some of that and putting it into your after-tax account this year, okay? Again, when you're running your own show, you've got to make the decision for that, all right?
Any questions on stock diversification?
I have a question.
Sure, go ahead.
Okay, with an RMD, next year I have to take my first RMD.
Okay.
Do you let the money accumulate as cash, or do you, let's say I have, I'll have to take $60,000, $70,000 for my first year based
Okay.
on what I have in my IRA for the first year.
Right.
The money is earning dividends, interest, what have you, and
Sure.
right now cash is about 20,000. Normally, I would have reinvested my $20,000 and constantly do it, but I'm letting the cash accumulate. Do you do that, or do you let it accumulate? And then do you take that $60,000, $70,000 the beginning of January of 22, or do you wait and take it out all during the year?
Well,
Again, I've never had to take an RMD before.
It's like what Morley says, it depends on your individual situation, okay? So a good thing to do first, before you even get started, take a look at the asset allocation of the IRA, okay? If you want to create it, like, I think we discussed this, how you create an annuity, okay? Take a look and say, okay, let's just say, for example, you have a 50-50 allocation, 50% stocks and 50% fixed income. If that doesn't generate very close to what your RMD is next year, start to move some of your equity over into fixed income, or make sure that your equities pay a substantial dividend, okay? In order to
So
create.
in other words, you don't reduce your principal. Okay.
Right, exactly. So that's how the annuity business works, okay? You can be in your own annuity. So make sure that you have it. You won't stick your finger in the principal, and the annuity will outlast you, okay? Not vice versa, okay? Now, if you still don't come up with the right number by the time you get to first quarter in 22, then allow it to go. All you have to do is take it out in that calendar year, okay? So if you allow it to grow, then move your cash over to your after-tax account, and then decide what you want to do with the RMD at that point, okay?
Right now I'm looking, it's fixed income is 40 of the IRA. 41% US equity is 44, and then
Okay.
it's in cash alternatives, cash US equity. Okay, so it's about what you're saying, and it generates enough income to generate that 60, 70,000.
Good. So then you don't save it. You've given your answer already, okay? I mean.
Okay, thank you.
Right.
But
Okay.
the other part, should I take it in the beginning? Do you take it in the beginning of January, or
It's up
whenever?
to you. It depends on what your individual needs are. I have
Okay.
clients that take it out December 28th. I have other clients that take it out January 3rd, you know? So it all depends. If you have a reason to take it out, you're building a tax-free portfolio in your after-tax accounts, do it, okay? If you've been rocking and rolling right through the market and your IRA is doing well, then you can take it out quarterly. You can cost average yourself. You don't have to take the full 60, 70,000 in one shot. You can take it out
Okay.
15, 15, and 15, okay? And
Yeah,
that's
Thank
Michael,
you.
another thing,
Thank you.
you can take the distribution in kind. You
Yep.
don't have to take it out as cash. So if you have, I'm making up a thing, 100 shares of AT&T you want to take out, you can tell your broker, take out 100 shares of AT&T instead of cash. And then they value what the stock is.
give you a valuation.
Distribution.
Yeah,
And what are you saying? And then you just transfer that into your other account with him and you're not selling it?
That's,
you
you
don't have to-
transfer it over, right?
Yeah, okay.
yeah, let me just tell you one more.
You get stepped up basis in effect.
The reason that people used to wait till the end was they had the money in the money market, and the money market's paying 5%, so you might as well let it go to the end.
Right.
Today, it doesn't really matter because you're not earning anything on that cash.
Right. Thank you.
Okay. Anybody else have any other questions as far as IRAs or RMDs or using their money
Question.
efficiently or,
I have a question.
yeah, good.
It's in reference to the taxable account that you're moving that money out,
Right?
your IRA or whatever. Would you move it into a Roth or a regular, just an account?
Do you see any purpose of moving it into a Roth rather than using it? I mean, again, it depends.
Well, if you
on what-
didn't need it, if you didn't need to use it,
Yeah.
and you wanted to take it out before the tax goes up, like you were saying, maybe in 23, and you took some out, would you put it in a regular account where you're going to have to pay tax on it when you go to draw it down again? Or would you put it in a Roth that you don't have to pay
I
tax
think you
on?
put it in a Roth.
No, you don't have to pay tax when you draw it down again.
Yeah,
If you take
that's
money
after
out of the
tax money.
IRA,
Yeah.
pay a tax on that amount, you put it into your individual account, you do whatever you want with that. The only tax you pay is if that money grows or that stock grows and you sell it, then you have a tax to pay.
Yeah, that's why, right. And that's why I said to you, you may want to create some tax-free investments over in that after-tax account if you're so concerned about paying taxes on gains in the after-tax account. It all depends,
All
Maybe
right.
maybe you'll
Mike,
take
I
your
see-
wife on a trip next year if we're all traveling again or whatever.
I see it's amazing.
Right. Thank you.
I see people, clients, not clients, but people that ask, well, if I take money out of my account, do I have to pay tax on it? Like they take, let's say 5, 10,000 a month, whatever they're taking out. Well, no, you only pay tax if the money makes any money. What you take out of your account is not taxable unless you're selling a stock. It's not, you don't get taxed again. And that's a misconception that, some people have, which is incorrect.
So if you took that 20,000 you took out, and yes, you invested it in IBM or anything or Verizon and paying 4 or 5%, like Morley says, you will pay a tax on the dividends that they pay. And if you buy it at a price in January and you sold it, let's say in December, and there was a gain, yeah, you'll pay a capital gains. But if you just even leave it in money market or that you're going to use it or use it for something else or put it in tax freeze, no tax. Okay.
Thank
Any
you.
questions on diversification of stocks? Does everybody feel that they have good diversification in the stock part of their portfolio? And then my second question is, how do you know?
Right. Good question.
I mean, you might want to have somebody take a look at it and, who's in this business and give you some idea, what kind of portfolio you have and what the risks are and what the upside are. Is the portfolio, does it match what your goals and objectives are?
The other thing I add to what Morley is saying is that when you're looking not only in asset allocations, cash ratio to equities and so on and so forth, some of these portfolios that you're not using week in and week out, or month in and month out, what happens if we come into long-term sickness? Any member of the family, emergencies, Okay, where does that fit into the whole plan? So, it's almost more than just picking stocks and so on and so forth. It gets to the point, especially where ages start to kick in at 65, 70, 75, 80, of some serious financial planning. And that's difficult for people when they age, because I've done it this way for 74 years and it's worked. Okay, fine. But as you move on in life, we do know that you have a better chance of financial challenges going forward, okay, unless you've prepared for that one way or another. When you're younger, life insurance is not as important now as it was 20 or 30 years ago. The worst is more the long-term care, okay? So take a look at that when you put that in, and take a look at that as cash or fixed income. And that goes back to, even though bonds are not a great investment, your bonds will be much less volatile. I don't care whether it's closed end or individual, than stocks will be in a bad market. Okay. Right now, the market is definitely responding to another $2 trillion of printing money. Okay. And things only look like they're going up every day. I will tell you from doing this, and Morley, that's when you got to start to watch and wonder what the next step is around the corner. Okay. When things look too good to be true, they are. You've got this opening trade that's coming in now, and I think it's great. It'll probably continue for a little while. Okay. But the market is way ahead of the real economy. All right. And you're going to have, they're talking about GDP growth by late second, certainly third and fourth quarter, may go to 6 or 7%. That's unheard of in almost post-World War II. Almost talking about late 40s, 50s, sometimes early 60s, that you get this kind of growth, because you're going to have this pent-up buying. You're going to have the government printing money, okay? And we could have the explosion, which is kind of what the markets are telling you right now, right? So just remember that you have your own individual challenges, all of you, your spouses, children, grandchildren, whatever it is. So make sure that you have all those things planned on when you do your financial planning. Okay, I think it's important.
Let me say one other thing that people don't think about. I was with a client going over his portfolio, and he said, "You know what?" He said, "I need $30,000 next month." Okay, what do you need it for? Well, my son-in-law is out of work. They have one autistic child, and I need to help her. So I said, "Does your son-in-law have life insurance?" He says, "I don't know." I said, "Because if something happened to your son-in-law, that whole burden is going to fall on you. Or if you have other children, it will fall on them to take care of the children. And you've got to leave them some money so that they're not burdened and they can take care of that child or those children." So, these are things that hopefully never happen, but they can, and it can change your whole retirement plan if something like that happens. So maybe, for $3,000 a year, you could buy $1 million or $2 million life insurance policy for your son-in-law, even if he doesn't have any money to pay for it. And that would be a good investment. So it's just something to think about.
Morley, isn't it true on the, I know a fellow who, he's insurance, he's a broker, he's a financial planner. And I met him through an insurance, because I had, at the time, I don't know what insurance company I had, but anyway, he wound up, I met him out here. And he's been telling me for years about that. You look at your portfolio, you've got to help somebody out paying an insurance, paying a huge premium for an insurance policy that pays off. And in one example, I know somebody out in Arizona got involved in a bad deal. The guy's daughter ran off with the investor's money, one of those deals. And the guy said, "I will pay back everybody. I am going to pay it back." And what he did is he took an insurance policy out on his 92-year-old mother. And when she died, a couple of years later, she died. He paid everybody back. I don't know what it cost him, but it was probably a whole lot less than if he would have taken his own money to pay everybody back. So, I guess there's ways of looking at insurances that we don't even think about because we figure we're too old to get a policy. But that's not true.
Yeah, like I say, it depends what the insurance, for, and depends what your own individual family needs are. But, we find that, Molly and I talk about this all the time, we find that people sometimes stick their heads in the sand and think, money will fall from heaven or so to correct this, rather than doing, like you just said, do a little planning and shopping around and do the just in case scenario, just in case something like that happens. You don't have to, put yourself in debt over this, but keeping some of that money, because quite a few of you said, oh, I don't need the money. I don't need the income. Well, that's great. And it's wonderful. Obviously, you realize you're in the minority compared to the majority of people that live in the United States. Okay. So just make sure that all that money that you don't need, that you may need to just allocate somewhere else. Okay. Just in case. I think that's a good point.
Okay, let's just talk about, how much time do we have, Len?
Well, I signed up from 7 to 8:30, 8:45
Okay,
because it doesn't matter.
Okay.
Yeah.
I may have to jump off in about 20 minutes, but go ahead.
Yeah, we can stay on as long as people.
I want to hear the president.
somebody had a question?
Yeah.
You raised your hand, who's that, Rob?
I have, okay, I'll let someone else.
Go ahead.
No, I'm interested in disruptive technologies. That's my sort of fun thing.
Okay.
I let Schwab manage whatever they're gonna manage. And
Okay.
then I have a fun a little bit of fun. So far, when I listen to other people, I don't do as well as when I do it myself and do my own research.
Who are you listening to?
I don't want to mention his name.
Well, didn't you say Schwab is managing your money? Is that who's
He's
managing?
managing some of it, not all.
Okay.
Yeah.
Well, you know what? First thing I'd say to you, Len, put those people, whoever's managing your money, you don't find that they're doing the right job, put their feet to the fire.
That's
And
my
they get-
income. They manage it primarily at a more income oriented.
Oh, okay, so that's fine. If what the money is being managed for, it achieves the goal, that's fine. You don't have to have 20% on your money if you're looking for monthly income, okay? So just know what that money is for and make sure that you're getting a reasonable return. That's all.
Yeah, but one of my sort of hobbies, I guess you could say, is all of these new technologies and finding. I'm looking for stocks mostly. I'm not looking for ETFs particularly, that have not turned the corner yet, but have interesting prospects. That's my interest.
Okay.
Well, I would suggest what you do is you find those stocks and you take $10,000, put $1,000 into each one and put them away.
Yeah, well, that's what I've been told, but I'm still in a lot of cash and I'm just figuring out what I'm going to do. I've taken some profit because I think that the market is somewhat overbought.
Well, take a look. Some of that research can be done for you. I think I mentioned this closed-end fund to you before, okay? We mentioned it before it became hot on NBC, ARKW, okay? She's on the woman Woods.
Kathy Wood. Yeah.
She's the one, she's on now every other week. We mentioned it 2 or 3 months ago. You don't have to buy that. Not that you've done badly. I mean, I have people that have that. They're up 30, 40, 50%. But I understand what you want to do. Take a look inside. All you have to do is Google it. Take a look at her top 10 holdings, top 12 holdings. She has a next generation fund, okay, that she's saying this is what's going to happen over the next 3, 5, 10 years. Take a look at those companies inside of there. People much smarter than me and you have already taken a look at those, and they take positions very early on, okay? So, and it's everything. Now, some of these you may not be interested in. You may not be interested in, game technology. I'm not talking about GameStop, okay?
No.
But
You want the infrastructure more than.
exactly,
Yeah.
exactly. They get involved in that and they spend a lot of time doing it, okay? So you may find from that point of view, I'm just looking if I jotted down some, yeah, that you may find that the companies that they have already taken positions, they may hold them for a year, 2 or 5 years. That may be something that you're looking at.
I hope I'm here in 5 years.
Well, that's the point I was going to make to you. When you say that you want to do next generation type of thing, what's your timeline? It's almost no different than buying a bond that Morley was referring to. Oh, you're going out 3, 5, 10, 12 years, okay? What are you looking for? You're looking at a return on your investment over the next 12 to 24 months. They've done a lot of the research for you, and they'll narrow the field down from infinite, at least to take a look at 5, 10, or 15 of those type of companies you're looking at. That's their focus. So take a look in there and you may find a nice basket to jump on, okay?
Can you mention the name of that fund again?
The symbol ARKW.
Is it ARK? She has several funds. She has
Yes, but start there.
ARKK.
Yeah,
She has an Israeli fund too.
right.
Yeah.
It's known as ARK, yeah. So take a look at those if you like to play. That's a place to play, all right?
Yeah. The problem is getting in before the curve turns. Well,
Wow.
she made a lot of money on her on Tesla. Tesla went down in the 500s and now it's
Right.
up to 600 something.
Right, well, it got up as high as 8 and change, okay? So again, if you're talking about getting in early, by the time already with SPACs, by the time things are coming to market, it's getting late, all right? So unfortunately, as the small guy, you're late into the game versus the guys that are VCs, venture capitalists, they were in 5 years ago. So it all depends on what you're talking about. You're really talking about getting in midstream, okay? Or something that's been beaten down, turn around, okay? Take a look at a stock like Merck. That's been beaten down for a number of different reasons. I think very shortly you will see a 6, 7, 8, 10% increase in a Merck because of some of the mitigating drugs they have coming to market versus the viruses. Yeah. So you don't have to, do a .com in the old days or a tech to get something that you want to buy for value. And that's something you mentioned in the outline, value versus momentum. We're in a momentum market right now, but value has a lot of good benefits to it. People should be looking, I think we mentioned this a month or 2 ago, should be looking toward still financials and some energy. A little late in the energy game right now, and there's a good reason for that. Financials, because interest rates are starting to push up. That's when banks and financial companies make money on the spreads. They get the money cheap and they can charge us more. So you like that? Net margins, profits. So banks and financial for the rest of 21 going into 22. Wait, they'll pull back a little. They ran up, but there's plenty of time to play. Energy, let it come back down a little, but just take a look at start with the big oil companies and work your way through there. Okay, look at what the price of a barrel of oil all of a sudden is. All right.
Maybe you
So-
can. Go ahead.
What's your feeling towards clean energy causing problems with the oil industry?
I think that it's partially been discounted already, looking at the oil stocks where they were 6 months ago and where they are today, okay? Nothing's going to happen overnight as far as clean energy, okay? So clean energy is still going to need energy, okay? If we're going to make up, I don't know, 50 or 100,000 charging stations, what's the energy for that, okay? It's going to be a conventional energy to start off with. To even get the charging stations going. It'll be better for the atmosphere and for the climate, not having all of that fossil fuel spilled into the air, but fossil fuel's not going away. All you see, take a look what Exxon bottomed out, and they're not even the best run company at 35, 36, 62 today. You missed it already partially, all right? Because we brought the supply down to meet the demand. all right? When you're talking about EV, electric vehicles, so on and so forth, I hope we're all around to see it, okay? Let alone driverless cars, maybe, okay? We'll see how fast that goes. And again, what's your timeline? You know, if you said to me, "Ugh, I just stepped out of college," great. We'll give you these kind of things, be 35. If you're telling me you're only going to be around another 12 or 18 months because I have a terminal disease, well, that's another story. So it all depends on your time frame of investing, okay? I think there's a lot of excitement going on in EV. You can play that. You could have played that. GM only jumped 20 points already because GM and Ford, as chaotic as that place has been, went from 9 to 13 in the last 3 or 4 months because they're bringing those monster brands onto the market to do what Tesla has done already, okay? Does that give me an answer to the question or no?
What's your view of the large, large growth type funds versus small, medium, or value versus growth? The big jump has been in more towards the growth for at least large growth. That's the big jump.
Yep.
Do you see what's your outlook in terms of?
I'm not big onto the classic open-ended mutual funds that I think you're talking about.
Or ETFs.
ETFs are a little better, but again, when you're even buying an ETF, just like we were saying with Len, it depends on what the manager is sticking in there, when they're taking out, when they're putting in. If you have a limited amount of money to put into a certain sector, okay, finance, energy, they're great. Client says to me, okay, I got 100,000 extra, let's diversify. Doesn't really have a ton of money to put into one company. So we diversify through ETFs, okay? If you're saying to yourself, do your homework and find out what you think some individual companies are doing, plus their dividends, to give you the total return. I mean, what's the goal? Again, I'm never clear what the goal is. Is the goal get a total return of 8%, 10%, 12%? I don't know. You're the investor. You're making the decision. You got to say to yourself, what is my goal looking for return on money? The bottom is money market, 0. CD, 0. Okay, so from CD and money market, now you're moving up the ladder. Morley mentioned 10-year, 1.5. A higher yield, or even conventional bonds in a bond fund.
I put it on
3 to 4%. Okay, high yield, HYG, go there, you get a little closer to 5%. Now, for the risk you're taking in the equity market, you should be shooting for 7, 8, 9, 10% to try to get a return if you do your homework. And it's a batting average, okay? Nobody bats 1,000, so you're hoping, you can bat 4, 5, 600.
I should
right?
maybe.
And that's the return that you're looking for. But with that return, you've added risk onto it. So how much risk? You and I went back and forth about running around for CDs last year. So how much risk as an investor are you willing to take as an investor? And that's what you have to ask yourself. If you're willing to take the risk, it's a million things to roll the dice on, okay? And how much work do you want to put in to do it? I mean, my company, we spend millions of dollars on having analysts take a look at companies. That doesn't mean they get it right all the time, but hopefully we beat out the guy that throws it at the dartboard. Okay, that's the key.
Want to thank you. I'm leaving. I want to listen to the president, but thank you.
Absolutely.
I learned a lot.
I
Thank you.
don't take any offense to that at all. He's doing
Yeah,
a good job. He's doing a good job.
Likewise. Thank
Yeah.
you very much.
All
Bye-bye.
right, take care of yourself.
Here.
All right, are there any other topics? I have a lot of topics, but they're not mostly conservative type stuff. I don't understand. There are people talking about something called distributed manufacturing, which is what we do now. We ship all our manufacturing all over the world. And the Biden administration is talking about bringing back manufacturing. I don't understand how that's possible if if this is the new business model for manufacturing.
Well, I don't think you can take, Len, I don't think you can take manufacturing just as a, a blanket type of subject. I mean, certain things, if the consumer only wants to buy, take Nike shoes, okay? And if they can only make them in Thailand to make the margins that they need to retail finally at $90 a pair, then they need a certain amount of labor force or whatever in Mexico or Thailand to make those. If they need less of margins, or they can retail for 125, then you could do better in the United States, okay? Therefore, the demise of the textile industry. On the other hand, if you take a look at anything that's connected with tech, we obviously can do that because the margins are just so huge, okay? We have a real shortage in the world right now. This is an interesting topic, of chips and semiconductors, yeah? So even if you have the worst chip business, which believe it or not right now is Intel, okay? It's moved up a little bit. There are better companies in that business, but there's such a demand, companies are buying anything. And why? Because of the automobile business. I think we said this a few meetings ago. You're not buying a car anymore. You're buying a machine that has technology that you just happen to drive into it. All right. So that's just a huge, huge business. $90 billion a year in autos. So there you can improve the business in the United States because we can afford to make it here and still have a retail price for it and move it out, so on and so forth. It's a problem maybe with, like I say, Nike shoes or apparel or so on and so forth, because the consumer will not pay what we need to charge them for to manufacture it here. So I think it's what we're talking about. It's a little political talk also, but whatever, of doing everything domestic. The world it's a global world.
Yeah, I'm not much of an economist, but maybe Michael Eisner knows more about this. They talk about, this is John Keynes' concept, sending things to the places that do it the best or the cheapest.
Yeah, well, automobile manufacturers do that all over the world.
Yeah.
They have a wonderful logistical scheme. Look at what Amazon does as far as logistics. It's amazing. Okay.
So to bring manufacturing back, jobs back to the United States, I'm not clear on how that happens.
I think in certain industries it's possible, okay? In others, it's probably not practical, okay? Because you just, the consumer won't buy the end product at the price that the manufacturer would have to charge them, all right? But if you can increase your manufacturing in the US, even 3, 4, 5% a year, whoa, that would be a major breakthrough, all right?
Yeah, but you got to look at there's certain critical things that we maybe have shipped too much onto foreign countries, like chips.
That's why Taiwan Semiconductor is the #1 chip manufacturer in the world today, because we outsourced a lot of that chip business.
Medications we've shipped to India and China.
Correct.
These are things that I would say these are critical things. Steel, another critical area. So there are certain areas that are critical that you want to bring back manufacturing, but we don't have to make toys or T-shirts and stuff like that.
Yeah, well, even like you say, Morley, the generic part of pharmaceuticals, you take a look at your drugs in your medicine cabinet. Half of those things are somewhere between India and some third world country, because the manufacturers need to maximize their dollars in that generic business. That's a very price sensitive business. So they want to bring their costs down as far as possible versus a new drug that comes onto the market. Welcome to capitalism.
It makes sense to produce things that you can produce cheaper that you don't have to do here, and use the resources in an area that is incremental or additive to the economy here.
We do well with a skilled labor force. Just know that you have to pay for it, okay? But we do well with the skilled labor force. And in certain segments, we can probably do that. They're now looking to possibly along this chips and semiconductors, that the government would help out, which is what really happens in most other countries. The government would help out and help to bring some manufacturing back. And then you have like the automobile manufacturers. Didn't Toyota and Nissan, they started to build cars in the United States, okay? And dealerships and so on and so forth when you go back 30 or 40 years. So it's doable in certain sectors of the economy.
I have a question.
Yeah.
In reference to Intel, you mentioned that it pays a pretty good dividend, but it's not one of the top chip makers. Would you unload that if you had it now?
I did. I've been unloading it, yes. I think, again, everything happens to deal with timelines. They just put in a new CEO. They changed around some of the management committee and so on and so forth. If you're going to stick with it, well, if you had 1,000 shares of it, I would say I would start to maybe take 200-300 off at a time. 62, I think it's 62 or 63. It's a great price to where it's been. I would start to reduce my exposure. If it's 100 shares one way or another, whatever, okay? But it's going to take them a while because in that chip business, it's the thickness or thinness, as the case may be, of the wafers of the chips. They are behind both Taiwan Semiconductor, AMD, and MU. Can they get back? Yeah. You want to stick around and wait? Go ahead, okay? I think that's basically kind of the answer to the question, okay?
Thank you.
Add to that, Michael, that
Yeah.
if no one stock should make or break your portfolio. So if you've got a really large position in something, then that's risky. So, again, a good portfolio does not have very, very large positions in the portfolio and very, very few small positions. So if you sort of even it out, when it gets to be too big a position, take some money off the table, put that into something else.
Right. That's why we talked about the retail investor knowing when to sell, okay? And that's important, like Morley says. Even if you go to cash for the time being, you wait for an opportunity to redeploy the cash. It's not like you have to sell it and buy the same day that you sold something else, okay?
Thank you.
All right, good.
I recorded it. There was a glitch at the very beginning when we're talking about Bitcoins,
Yeah.
but I got most of it. And I have my video editor by the name of Steve Birnbaum.
Great.
And
Does anybody, Len, has anybody wanted the next session we have, they want to talk about any, specific topics, whether it's, that, or do they want a little background on what's going on in the world of SPACs, if they know what SPACs are? If there's a different way of bringing companies to market these days. If there's any interest in that, we can do that. Let's see, I made a list of a couple of things.
special purpose,
I don't want to bore anybody to death. So, if
what
that's,
does A stand for, Michael?
I'm sorry,
Special purpose. A.
special purpose acquisition companies, right?
Uh-huh.
So they're created and then basically grab capital and then they bring private companies to market. The world is changing so fast. You have to run hard to stay in place. Okay.
Why are they doing that though? I mean,
Oh, much more efficient. Before they used to go to Merrill or Morgan Stanley, and then they do a road show and see what institutional. So a lot of what's going on in the world today, somebody just said, and I think Seinfeld was way ahead of it 20 years ago, cutting out the middleman. Okay. How do we get from the origin of the product right to the consumer? And what everybody is figuring out right now, if we can do that, we can be so much more cost efficient and the consumer can buy whatever we're talking about at a much more efficient price. It's amazing what's happening right now. Very exciting, but upsetting for those of us that want the world to be like 30 years ago. So, every once in a while I have to call my two sons to check on technology because I want to shoot myself sometimes, But, still very exciting. It could be another roaring 20s like 100 years ago. Just let's hope it doesn't finish like it did,
yeah.
All right, so if anybody has, like I say, any of those things, we can, whenever the next meeting is, we can talk about them. We can get into, anybody seen what's going on, like in the art world that's being created?
Digital art auctions.
Yeah, the last one just was reported yesterday, right? $69 million he sold a piece of art to. Unbelievable, okay? That was created. We can get into how that's done, if they so wish. That's another sort of spin-off of cryptocurrency. So if any of these are interest, Len, let them write to you and we
Yeah.
can have that kind of
I'm open.
discussion.
I'm open to any ideas that people
Yeah,
have.
I mean, whatever people are interested in, but there's a heck of a lot of newness coming on and I think it's going to continue, okay?
I agree. That's one of my interests, not
Great.
that I'm in the market for digital art, believe me.
Oh, okay, so there you go. Then you give the rundown then next time.
No,
give us
well,
a
what
little.
I'm interested in is, like I said, finding companies that haven't turned, whose stock has not turned the corner yet. And I get in just after, I understand that the initial investor, and then there's a pipeline on these SPACs or whatever it is.
Sure.
And then there's people like me,
Is the lady still with us whose son is in sports collecting? Is she still with us or no?
No,
Barbara
she's
Iskowitz, that I'll call her after the meeting.
Did she leave? Yeah.
Yeah,
I'd be
well,
interested in talk-
yeah, I guess she signed off.
She
but-
said, all right, we'll catch you next time.